Finding you this. Good evening, everybody. Welcome to Thursday night Debt-Free Life with Scott Forehand, Agency Director at Symmetry Financial Group. My name is Tom Deutsch. I'm an agency owner, director George and Janet Matthews. A little bit of a background for some people that may be new. Symmetry launched Debt-Free Life. Has it been 3 years now, Scott?
May 2019, baby.
Okay, no, 2 years. So 2 years. Okay, we're into our third year. We used to talk about the debt that we've retired so far, and it was kind of hard to keep up with. So now we're talking about the debt we're going to retire. The corporate goal is to retire $1 trillion of consumer debt. And that's something that we're all standing behind, thanks to Mike Resma and the new training that's going out that way. Scott has been one of the pioneers for Debt-Free Life with us. He had a major hand in developing the new software that we're using as a company, and he's been gracious enough to spend some time with us to go over Debt-Free Life, give an overview, and have a Q&A afterwards. He also lined up a superstar special guest for us tonight. So without any further ado, Scott, take her away.
Thank you. What's your name again? Tommy D? Tommy D. Thanks, Tom. So again, my name is Scott Forehand. This is the Thursday, twice monthly DFL training that we do and DFL class. So if you're an agent and you're here to learn, fantastic. If you're new to Debt-Free Life and you just want to find out what it's about, fantastic. And if you're somebody's client, then just fantastic. Welcome here. And make sure that when we're done with this, you get back with your whoever referred you to this this presentation and get up with them and get on your track to become debt-free and have a fantastic retirement. So Debt-Free Life. What is Debt-Free Life? Debt-Free Life is a proprietary program, like Tom said, that was launched in May of 2019 by Symmetry Financial Group. It is not the concepts, the financial concepts behind Debt-Free Life have been around for a long time. And there have been other iterations of these programs that have come before us. I'm not going to say any of their names because all of them have failed for one reason or another. But what I will say is, when we created Debt-Free Life, we took into consideration the reasons for failure, and we built in stopgaps into the system. And we took into consideration the 10 most common reasons why those previous programs failed. And we make it so that you can't fail for those reasons. So let's go ahead and start. Debt-Free Life exists because of this. 2 questions. Are you sure you're going to have a great retirement? And I don't think anybody can answer that question. And if you could show you a way to get out of debt in 9 years or less, without spending any more money than you're already spending right now, would you be interested in listening? Hopefully that's why you're here. But I just want to comment on this. This is not what I've seen, and I'm sure Keith has seen it as well, and everybody else who's written programs on here. The illustrations that we run, it's not just 9 years or less. It's significant about the number of years early that the debt gets retired. So what I'm seeing typically is anywhere from 15 to 27 years early. I had a family that had a 30-year mortgage, and we got them out of debt in 2.6 years. Okay, so these programs work. Every one of them is different. Every one of them requires customization. Every one of them requires an expert to have you set it up. So make sure, like I said earlier, you get with the person that invited you here and sit with them and get on your track, your path to debt-free. So if you're like me or you're like most Americans, this is what your income looks like on an annual basis. You spend 34% of the money you make on interest, 40% of the money you make on taxes, 23% of the money you make on your lifestyle, that's your living expenses, paying your bills, put food on the table, paying the power bill, gas bill, light bill, all that stuff. And then if there's whatever's left is your Netflix and your Hulu bill recently. And then finally, we save 3%. And it's great that we're saving, but the problem is that you've been existing and living on 100% of your income, and now we're expecting you to try to live on 3% over a period of years. And most people have a concern, and rightly so, that they're going to outlive their money. That is the number one concern for retirees. Their number one concern is that they're going to outlive the money they've got saved. And the beautiful thing about a debt-free program like this is that we're going to eliminate that concern. We're going to make it so if that's what's keeping you awake at night, you're going to be able to sleep. All right, so moving on. So we want to change things around. And this is going back to that last slide that we were just looking at, that 3% of the savings. This is what the average American does with their lifetime. Over their lifetime, they're going to make $2 million a year lowering break rates, or $2 million in their lifetime, but they're only going to save about 60,000. That's 3%. There's a problem there. And the problem is you make a lot of money, but just don't save enough money. So this is what the Debt-Free Life program is designed to do. It's designed to put you on the straight and narrow so that you can get to that point where you're not saving only 3% of your money for your permanent retired income. And also that last question down there at the bottom, is this the American dream? Absolutely not. This is not what the amount of taxes that we pay, the amount of interest that we have. It's a conspiracy, really, that we pay so much in tax and that we have so much interest that we pay out over time. And it doesn't need to be that way. And it certainly isn't the American dream. So when you start thinking about debts, maybe you decide to talk to a quote unquote professional who calls themselves a debt counselor or a credit counselor or a debt management specialist or whatever term they want to make up for themselves. The end result is they've got 5 cards in their deck, and these are, or 6 cards in their deck, and these are the 6 cards they play when you come to them. They're going to tell you to go get a second job, work harder, spend less money, save more money, refinance everything, consolidate. I don't understand the whole concept of consolidation. Why would you take all of your debt that you can pay off piecemeal over time and put it into one big thing that you can't pay off quickly? Why would you do that? It doesn't make any sense. And why would you refinance? One of the common things that they look at is if you've got equity in your home, they'll tell you to take out a home equity line and essentially trade equity in your home to pay off a debt that didn't have any right to the equity in your home to begin with. It just doesn't make any sense. So all those things that they tell you to do, all those recommendations they're going to make, there's only one of them that's going to work with regularity, and that's that debt snowball. The problem here is that most people have a concept of what a debt snowball is, and it's incorrect. There's actually a thing called debt stacking, and what people traditionally think of as a debt snowball is actually debt stacking. And there is, when we look at these programs that we're going to show in just a few minutes, there is only one best way to eliminate your debt. There's only one way that's going to create the most cash for you for retirement. There's only one. And the debt snowball, a true debt snowball, is what you have to do. And you cannot do debt stacking, which we'll talk about that in just a minute. So moving on. If we could, and we asked this question, if we can eliminate your debt in 9 years or less without spending any additional money, would you want to listen to us? This is our better way. Of course you would. That's why you're here. So how do we do this? Let's talk about that for a minute. So first thing, our goal is to get you from A to B, to get you from the left side of the screen to the right side of the screen, where you're saving 3% of your money. Instead of you saving 3%, we want you to save 15. Where you're spending 23% of your money on your lifestyle, we want you to get you to the point where you're doing 33%. That's a huge difference, everybody. Just look at the math. So is that 10%? It isn't. It's 40%, really. So if I tell you at the end of the month right now, you have $1,000 a month left over in your checking account, and then after we go through this process, set up a debt-free life program, put you on that straight and narrow, we're going to get you to that point where you have 33% of your income available for your lifestyle. The number is only 10% higher when you look at this, but the reality is that number is over 40%. That means we're going to give you more than 40% more at the end of the month that you've got left over to do whatever you want to do. So what that means is you got $1,000 a month left over every month right now. That means we're going to change that to $1,400. And if you do that and compound that effect over the year, that means in that $1,000 example, we're going to increase the amount of spendable cash that you have to do whatever you want to do. Take that vacation, buy your wife a new diamond ring, hint, hint, whatever, $4,000 over time. Actually, it's $5,200. So let's move on. So how are we going to do it? We're going to reduce the interest you pay to lenders over time. And what way are we going to do this? We're going to pay stuff off faster. We're going to turn debt on its head. We're going to change the paradigm, change the discussion, and make it so your debt is working for you instead of against you. We're going to eliminate all your debt in 9 years less, 15 to 27 years early. We're going to reduce the taxes you pay over time. We're going to improve your cash flow. Because at the end of the day, we all know if I have to, go become a Walmart greeter and eat ramen and tuna fish for the next 6 months just so I can pay one bill off faster, that program's not going to last. It's not going to be supported. I'm not going to support it, and I'm going to quit. So there has to be a short-term, tangible reason why we do it. And one of the biggest things is that's usually a barrier for people to enter into these programs is cash flow. So we're going to increase your cash flow. And finally, we're going to allow you to retire with a tax favored income. I don't know about you, but the most tax favored income I can think of is one that's tax exempt. And I'm sure that DJ Debt Free will agree with me. Tax exempt is the best way to go. So one of the things I spoke of earlier is I talked about why those previous programs that came from us failed. And the reason why they failed is because they didn't plan for unexpected events. And what I mean by that is they didn't plan for you to die early. They didn't plan for you to get sick and not be able to work. They didn't plan for some other catastrophic problem to happen. For example, if you and your spouse share the mortgage and now one of you can't work, there's the problem. So what we did is we built in an emergency fund into the system. The money's there. It's hidden. You can't see it, but it's there. And we're going to give you access to 80% of the funds as you move forward in time. The reason why we do this is we want that 20% emergency fund to be there for true emergencies. And we want it to be painful if you have to pull it, because we don't want you to go take that 20% out because you want to take that trip to Tahiti. We want you to take that 20% out because Uncle Joe just got diagnosed with something or other and is going to pass, and Mary Ellen can't afford anything, and then you can come in and be the hero and save the house for the family. A real emergency, things like that. So moving forward, we ran the numbers, and this is on a basic $10,000 investment over time. And these three tracks we look at here, one is a tax exempt solution, which is what Debt Free Life is. That's the greenest of the columns, the 66,000. The next one would be a tax deferred solution, which is a Roth or a traditional IRA. And the other is a tax solution where really you're just using the interest that you're going to gain from in theory, over time from a savings account or a high interest earning savings account. In the end, the one that's the best, obviously, is a tax-free solution, because where we go with this, with the initial deposit, the initial program injection of cash into the program, that $10,000, if we run it 28 years, 7% interest, and have a 25% tax rate, because we've already paid the tax on the program, there is no tax. That's why when you look at that tax deferred solution versus the tax-free solution, we've already taken care of the asset. We're not growing the amount of tax we owe like we are with a 401 or even with a Roth. We're not growing what we owe in tax. We're growing only the principal amount that's not taxed, because we've already paid tax on it when you put the money into the program. So moving on, this, like all financial instruments, works in phases: maximization, accumulation, distribution. So the maximization phase is the period of time where we are really trying to get you set up so that you can really turn, we're going to give you a Ferrari. This business is a Ferrari. This solution, this DFL solution, is a Ferrari. The maximization phase is when we're gassing it up with the highest octane fuel we can find. And what we're doing is we're giving you that oomph, that push, by helping you eliminate debt quickly. So in the maximization phase, the primary focus is not cash growth, it's debt elimination. The accumulation phase, that's after your debt is gone, but before you're retired, while you're still funding the program. The accumulation phase is where we've left the gates. We've got the hammer down, we're going 200 miles an hour, and we are doing nothing but building and accumulating cash as quickly as we can in the program. And then finally, distribution. We've parked the Ferrari and we're now buying a jet ski and we're going to Tahiti. We do whatever we want to do with the money. The distribution phase is when we're taking that money as a retirement income stream, which would be tax-free. I want to buy a second house or a third house. I want to fund my niece's college, whatever. You do it with the money what you want. But the point is that the money is going to be tax exempt and there's going to be a lot of it. Moving on. Like I said, this is not a new program. These people have all used this program, the concept of infinite banking. They've all used it before. Ray Kroc did it to fund his first 10 McDonald's units. Walt Disney used it to fund Walt Disney World. Doris Christopher did it when she started Pampered Chef. Warren Buffett does it to this day. It's a simple concept of basically becoming your bank. That's what we're talking about here. We're talking about creation of a private bank that you own, you control, you're the banker. You decide when to lend yourself the money and you decide what to charge yourself. Okay. But when you're lending your own money, I'm not going to charge myself 10% interest. I'm going to charge myself 0.76% interest until the banks go pound sand. Next, we already talked about this a little bit. We're going to redirect inefficiently spent money. We're going to show you how to do that in just a minute. There's a growth factor here. Every one of these, the companies that we use to provide these programs has a guaranteed interest rate, which let's make sure we look at that. You got money in a 401k, what's your guarantee? Your guarantee is that tomorrow the amount of money in your policy or in your program is going to change. I don't know whether it's going up or down, but I know it's going to change. Okay. The guarantee here is that I guarantee you that tomorrow the amount of money in your program will be higher because you're getting a guaranteed interest rate. It's above 3%, maybe as high as 4%, plus there's a dividend on top of that. So the growth is phenomenal and it's secure. And we're going to do all those things we've already talked about. That one of those bullets down, I think the fifth one, repay loans. So the program is using what we call dollar cycling, debt snowballing, and infinite banking. Okay, so the dollar cycling component of this allows us to spend a dollar, put a dollar in, spend a dollar again. The debt the snowball part allows us to pay off the debt and then pay a larger portion into the program, make the program roll faster and faster and faster. And then finally, the infinite banking part means that over time, as these programs mature, the amount of cash that they generate on them by themselves is enough to start paying off, or in many cases, completely pay off the loan in short order. So we're going to talk about all these things in just a minute. But that last one down there, leave a legacy. This is how the Rothschilds and the Rockefellers did it. You were able to transfer wealth generationally without having IRS intrude or tax. This is a brilliant program, and that's it's a phenomenal the way that it can work. And we talk about, and I say this a lot, that we're going to create generational wealth. I'm not joking. It's big, huge. All right. So when we first started this program, these are a couple of the first families that we helped. Retired $80,000 of debt, 84, 73. I'm sure that for those of us that are doing these programs with regularity, we see much, much higher numbers. The American debt load is not $84,000, not anywhere close. And we're going to do all this stuff by eliminating your taxes, reducing your interest, saving for retirement, saving in a tax-free manner, creating a tax-free retirement income stream. All these things are going to happen with these programs. So before we can understand how the program works, we need to understand how we spend money. So here's how we spend money. You make your money, whether you're an employee, W-2, W-4, or 1099. You make your money and you deposit that money into your bank account. Wells Fargo, Citibank, Bank of America, whoever. And then once your money gets into that bank account, that bank lends your money out over and over and over and over. The average dollar that you put into your checking account gets lent out 7 times by that bank before you ever get to use it. Okay, so they're making money with your money over and over and over. And let me ask you, how many times do they call you up and say, "Hey, Mr. Forehand," or "Hey, Mrs. Breitkreutz, we used your money last night. Thank you very much. We'd like to pay you some of what we made with your money." How many times? Has anybody ever gotten that call? No, doesn't exist, right? They're going to take your money. They're going to use your money. They're going to make money with your money. And in the end, the only benefit you're really going to get out of this is that they might say something like, "You know what? You've got more than $2,500 in your account with us. We're not going to charge you to keep your money in our bank." That's the only benefit. So finally, you go through the process, the bill comes due, you tell the bank to pay the bill, and then what happens? What happens is you have successfully transferred your money to your creditor, and it's gone forever. You'll never see it again. If you're really, really nice and super sweet like Lorene, you can ask them for your money back and they're going to tell you no. It's not going to happen. So all you've done is parked your money into a building, let them use your money, and then pay the bill. You've got zero benefit. You have a net sum zero gain from this process. There's a better way. Let's show you the better way. Here's the better way. This is the way you spend money with a debt-free life program. Just nothing changes about how you make your money. Nothing changes about what you do with the money when you get it. You deposit it into your checking account. Here's where the rubber meets the road with this program, though. What we're going to do is, instead of leaving the money sitting in our checking account and letting the bank use it over and over and over, I'm going to make a premium payment to my life insurance policy. That's what debt-free life is. At its core, it is a very specialized type of life insurance with some very special riders. We'll talk about that in a second. So instead of me leaving that $1,000, and I use that number in my checking account, I'm going to deposit that $1,000 into my life insurance account. And the way I'm going to do that is I'm going to write a check for my life insurance premium to my life insurance carrier. The nature of this program, because we want it structured the way that we do, we use a program called a whole life policy. There are some other solutions that are out there that use what are called indexed universal life programs. The problem with using an IUL for these is that the IUL return is not guaranteed. And if you happen to structure the IUL in a guaranteed frame, the guaranteed return is going to be less than the return that we're getting here. So that's why we use whole life. There's 3 carriers right now that we use. They've all agreed to offer the program the way that we need them to offer it. And so you're going to make your $1,000 payment into whole life. Now, it's one payment, one check that you're writing, one bill pay event that you're scheduling. That $1,000 goes up into your account. When it hits your account, it gets split 3 ways. It gets split into whole life, term life, and paid up additional life insurance. The whole life is the policy. That's what this is. This is a participating whole life policy. The term life is a rider, and that exists so that we can stash cash in this program, because IRS tax code 7702A says all money derived from a life insurance policy is tax exempt. Okay. But it also says if the cash value of a life insurance policy exceeds the life insurance value of the policy, then the policy is no longer life insurance. It's then what we call a modified endowment contract. The game is over and the whole thing is taxable again. So the reason why we have that term life umbrella rider is so that we can build the cash up underneath it while maintaining a large life insurance coverage amount over top. So we can build up underneath, and eventually, when these get fairly close, this third thing that we talk about here, the paid up additions, that has grown to the point that you can replace the term life policy. That's what's happening here. So to give you some specifics, the standard procedure that I typically use is 21% of the premium goes to pay whole life, 11% of the premium goes to pay the term life rider, and 68% goes to pay the paid up additions. Remember that thing I said earlier about the emergency fund? Where's that money hiding out? It's hiding out in the whole life. It's hidden there as cash in your whole life policy. It's there, you can get to it, but we don't want you to get to it easy. But it is still part of the whole calculation because you're getting paid interest on that and you're getting a dividend on that as well. So finally, we've got that term life, we've got the paid up additions, and what did we just do? We moved money out of our bank into our private bank. So now instead of the bank making money with our money every night, we are now making money with our money every night. And we're making a compounded number that we're getting on a regular basis. Where we move our money, moved our money into our private DFL bank. It's not sitting in our checking account. It's not sitting in our Wells Fargo account. It's sitting in our private bank. It is earning money for us, and it is a resource that we can tap into at will. So now let's say, okay, well, the time's come. I've been doing my debt-free life program. I've paid down my car to the point where there's enough cash in my DFL bank to be able to pay off my car loan. My car loan is $500 a month, but I'm down to $3,000 that I owe, and I've got $3,500, say, in my DFL bank. So I'm going to take a loan for $3,000. I'm going to take that loan and I'm going to deposit it as a carrier loan directly into my checking account. And then I'm going to tell my checking company, my bank, to pay that debt. Then they're going to send that money off to pay my debt. My car's going to get paid off. And then that money has become their money. It's okay. Where's my money? My money is still sitting in my private bank because I didn't take my money. I took a loan against my money. I used my money as collateral. Okay. So what I've just done is I've taken somebody else's money. I've paid off my debt with somebody else's money. And my money that I'm using as collateral for that loan is still earning interest for me, because the presence or absence of a loan against your bank value does not affect the interest rate that you're credited annually, or in the case that I use, monthly. Okay. So the idea here is that we want to make sure that we're funding the program correctly. We want to make sure we're using it correctly, not using it for crazy stuff, no emergency trips to Tahiti, none of that stuff. And we're using it to, if we're in the maximization phase, we're using it to eliminate that debt. Let's move on. You should have just had an aha moment about how you're spending money versus how you should be spending money. Okay. So let's look at this. This is a family that I did this program with back in October of 2019. Standard husband and wife. The husband was 36 years old at the time. We wrote this program on him. This gentleman's a truck driver. As a family, they have a lot of debt. The wife was a college student, a doctoral student at that time. She had a tremendous amount of student loans. Oh, by the way, student loans are evil. And then they have just normal debts. They had a house from before that he owned, and a house that they moved in together. And so they've got two properties, and they've got credit cards and some medical bills and back taxes and all that stuff. So where they thought they were about $580,000 in debt. The reality is they were $767,000 in debt. And the reason that's so high is because they weren't considering the interest they were going to have to pay over time. In their current strategy, before they met me, they were going to be in debt for 40 years. That's because student loans are evil, people. And they were going to be in debt for 40 years. At the end of that 40 years, they would be completely debt-free. They would have 100% equity in 2 houses, and that's it. Not bad. They could have sacrificed one of the houses to create some additional retirement income for them if they wanted. But there's a better way. So what we did for them is, instead of them taking 40 years to get out of debt and paying $182,000 in interest, we got them out of debt in 7.8 years and eliminated 70, almost half of the interest they're going to pay over time. So let's put that in perspective. That means over time, we gave them, just by doing this program, not spending any more money than they're already spending, we gave them additional $70,000 for retirement. That's the first thing that happened. The second thing that happened, besides the fact that we're eliminating all their debt in 7.8 years, is we're making it so that they're going to be able to hypersize their retirement program. Not just the fact that we're saving them $70,000 in interest, but now that 32.2 years that they have, they can use that without any debt. They can use that 32 years to build up a massive retirement program. And that was, remember, maximization. The maximization phase, we're eliminating all that debt. And then the final phase, where we're taking the distribution of that debt, or distribution of the cash, we're trying to get them to the end with the most amount of money possible. So how do you do that? Well, you do it like this. 40 years, $182,000 in scheduled interest, or 7.8 years and save $70,000 in scheduled interest. Which one would you choose? I certainly would choose the latter. But here's the cool thing, that down there at that bottom, potentially have 4.8 million. That's liquid cash, people. That's what this program created for them. This is without them spending any more money than they're already spending, without them taking on any additional jobs, This is assuming they never work a job and make more money than they're making now. They can never overfund the program more than is scheduled just from their debt load. That's just what this created for them, just from their debt load. The reality is this family, she's got her doctorate now. When we did this for her, she was only making $38,000 a year. Now she's making 110 as a professor at William and Mary. Okay, so these numbers are way off now. They're much higher for them. And that last part down there, if you look at the death benefit that it's going to create, because don't forget, at the end of the day, this is still a life insurance policy, right? This is a life insurance because of the paid up additions, it's paid up. Each one of those yellow lines from left to right that you see is a year in which some debt was paid off, one or more. There's a couple of key things I want to focus in on here. Let's look at this. In the first year, they took $14,900 from their program to pay off debt. So they paid off $14,900 in their first year. By the end of that first year, they had paid back most of that money. They were down to $8,600 left in debt. But more importantly, they had $12,000 liquid. $3,000 of it's hidden in the emergency fund. $9,000 is in their adjusted cash value for a total of $12,000. So in the first year, their premiums were $32,520. They paid off $14,900, almost $15,000 in debt. They paid off an additional $7,000 of what they borrowed. They created an additional $12,000, and they had a death benefit in that year of $1.06 million. Fast forward to year 4. By the time they get to year 4, all of their debts are gone except for house, and the evil student loan. Okay, so what happens here? The way this software works, we are not able to execute a payment because we don't have enough cash in the program to pay off the next largest debt, which in this case was one of their homes. So in the 4th year, we grow the cash value of the program to $91,000. We've paid back most of the loans we've taken. At that point, we've taken a total of 58, 68, 78, 87. We've taken $87,000 in loans. We've got $91,000 in cash. We've got $17,000 left in loans. That's huge. The very next year, we're paying off a house. Very next year, we're paying off another house. 2 years later, we're paying off student loans. And then look at this. 2 years later, all the loans that we took, they're all paid off. All $585,000 we borrowed over time, it's all paid off. We've got a zero balance. And now look at the growth. We're growing $110,000 cash value per year. Let's make sure we understand that. We're growing $110,000 cash value, but we're only putting in $32,000 a year. Did anybody have a holy cow moment then? You should have. This gentleman said that he wanted to retire at age 75. So we ran the program to age 75. If he did this, what he said he wanted to do at age 75, he'll have $5.05 million in the bank, zero annual premium, and his bank cash value will be growing at $200,000 a year. But I say, why retire when you retire at 75? Why don't you retire at 55? So at 55, he's got $1.5 million in the bank. That's not bad. I could probably live on $1.5 million, especially considering the interest that we're getting. He puts in 21, he puts in 21,000. We grew from 1.5 to 1.64 minus 21. So it's growing $110,000 a year. So basically he'd be able to take $110,000 a year out of the program without having to worry about taxes. Did anybody else get a holy cow moment just then? Are you falling asleep on me, DJ Debt Free? Okay. So one of the questions we get a lot is, well, what happens if I don't have a mortgage? Okay. Well, not everybody does. Pretty much everybody's got some kind of debt. So here's a woman that I worked with. She was 23 years old at the time, a master's student at Cal Poly. And her problem was student loans are evil, people. She had $90,000, $91,000 in $85,000 in debt. $91,000 was expected interest, most of which was coming from student loans. She was going to be debt-free at age 63. Not bad. Not a whole lot of debt. 177,000 once you look at the interest. But look, the interest is more than the debt. Interest is 91,000 and the debt's only 85,000. It's insane. Student loans are evil, people. So here we go. 9.7 years is what we did for her. So let's make sure we understand what we're saying here. In this particular program, for this example, we took her out of debt from 40 years to 9.7. That's 30 years early. Okay. And that means that that's 30 years that she's going to have to plan for her retirement. She'll be 33 years old when she's completely out of debt. That's not a bad thing. But what we did is we saved her $64,000 in interest. That's 2/3 of the interest that she was going to pay in. We saved it. And we created a tax-free liquid nest egg for her of $603,000 when she turns 63 years old. So if she doesn't want to go to 65 or doesn't want to go to 68, she can retire at 63. But wait, plus there's a death benefit that's all paid up. But wait, what if we don't wait until she's 63? What if we stop at 55? At 55, she'll have $409,000. This is a couple of things I want to make sure we understand here. That $409,000, that assumes she never overpays. She never stashes extra cash. She never, ever gets a job making more than she was making at the time we did this policy on her, where she was a waitress. Nothing wrong with waitress, okay? But her program is only $350 a month because that's what she could afford. Do you think she's going to put more money in later? Absolutely. Yep. Is she going to hypersize her retirement? Absolutely. Reality is she'll be able to retire at age 50 with over $1 million if she does the way that she wants to, the way she can. All right. So this is a life-changing event, a life-changing thing. Now, here's a couple things, caveats. The program will work for everybody at some point. You have to get with your expert, whoever invited you here. Because these programs are unique and they are unique per individual. And there's a lot of math involved, and we have to make sure that we're doing the right thing and getting the right amount set and getting the right ratios set based on what you tell us is your focus, is your goal, is how much debt you have and when you want to be debt free and yada yada. All those questions have to be answered. All right. The only reason that I can see that these programs will fail, there's two. Number one, if you stop funding them the way the roadmap tells you to, the way the plan tells you to. Or number two, if you buy that silly stuff. If you buy that new Corvette because you want a new car, go get a new car. Get a new Nissan or get a new Sentra or something like that. You don't need a Corvette. Not until you're in that phase where the money's good and it's level and it's static. All right. So I'm going to close this down. And we are now, let's see if we got any questions. All right, we're on track, Tom? I think we're on track. Yep. All right.
Yes, I'm here.
All right, so Jesse Baker put his phone number into chat, so I encourage everybody to take down his phone number and text him. Raise your hand if you can text him at midnight. All right, so those are midnight people. Who can text him at 1 a.m.? Okay, 1 a.m., 2 a.m.? I got 3 a.m. And we need somebody to do 4. So basically, we want to text them every hour on the hour just to make sure.
Any West Coasters?
There you go. Anybody in Alaska? There you go. There you go, Josh. Right on. Okay. So like Lucky loves spam. Okay. Victor, hey buddy. Rice and beans. There you go. Evil. Yeah. All right.
So I'd like to hear from Keith, Scott.
Say again.
I'd like to hear from Keith.
All right, Keith. Donna wants to hear from you.
How does your presentation differ, if at all, from Scott's presentation here?
I would say I'm not nearly as smart as Scott. I don't look as good.
I would challenge that, but okay.
I've put on that beard before, but it was fake. Look, here's what I would share. A couple of things for those of you that were invited here to look at this for the first time as maybe putting a plan in place for yourself. Congratulations, right? Don't be dissuaded by what you hear out in the media or what you see on TV. Really what this plan does is give you the power That's the first thing I would share with people. The power is in your hands, right? If I go to a financial advisor, I go to a brokerage, or even take advice from someone like Dave Ramsey, they're touching your money, right? And they're very practically directing your money. In this format, you're directing your money, right? We as insurance specialists, we never put a finger on your money ever. We don't have a license to lose it. So if you're, if you were invited here by someone and you're on video, could you shake two hands just so I can see who that is? Awesome. Well, welcome. Josh and Levon are shaking their hands. They're in my agency, in my downline, so I'm grateful they're here. But I was really talking about if you're thinking about being a client on this. I think what you're driving at, Misty, is really asking me how I sort of communicate to the client that this exists. Is that what you're asking? Because if you want, I can do like what I would present. And, if you could be on here for another 3 or 4 hours, that'd be cool.
It was Donna that asked the question.
Oh, it was. Okay. Sorry, Donna, go ahead. Can you give me a specific of what you want to know, like of what I might do or say differently?
Well, I don't want to dive too deep into it if there are clients that were invited here. I think most everyone here is an agent, but I don't know that for certain. So I think we all benefit from a different perspective or a different presentation. Different words resonate with people. And honestly, Scott is the only person that I've seen do the debt-free life presentation. So I was just asking what you do differently and what you focus on with your clients.
What great question. Okay. Couple of things, right? If you have an opportunity to go back to the debt-free living webinar from this past Tuesday, once they post it, go check it out. Because what I'm going to share, what I sort of present to people, I did in a little bit longer format there. But ultimately, for me, it starts with a financial fire drill, right? And for me, it starts with mortgage protection. And even before that, it starts with posture. Right? Most of us come onto this thing, especially when we're new, even if we're looking at this as a client, like, welcome, we want you to become experts because you're going to manage this, right? A year from now, 3 years from now, 5 years from now, we want you to have control. We don't want you to have to call an agent and go, what do I do now? I don't understand this. That's not the point here. So, remember that we're all experts in this and we don't have to know this perfectly, but what we do have to know is the banks are built on making money off of us. I mean, that kind of makes sense, right? Like, how does a bank fund itself? It takes the money that it makes, no different than any business, and reinvests it. So there's a couple of spots where I really like to hone in on what I call sandpaper the pain. So during the mortgage protection appointment, I will ask my client, are you overpaying your mortgage? And if they say yes, I ask them by how much. The important part there is not how much they're overpaying, it's the philosophy, right? The philosophy here is, can I take the same money I'm using and use it differently so that it benefits me and my family and gives me more control? That's the real philosophy. So someone who's in the vein of overpaying a mortgage already is in the mindset of, how can I get my debts down quicker? Right. For those of you who've never heard the name Tony Capistrano, I really encourage you to go find him. Right. Tony Capistrano, he's from Vietnam. Right. He's got a very thick accent. And the dude writes like 600 grand a year. And why does he do that? I was in a boot camp and he said it because he said, the reason I do that is because I focus on the people who want insurance and you focus on the people who don't. And the second Symmetry took down the barriers, meaning you could go virtual and buy a lead in any state. Basically, what they did was they made us more efficient on, if someone gives you an objection, get rid of them. Just find someone who won't. So now let's apply that to the debt-free life concept, right? If someone says to me, well, I'm putting this so much in 401k and I want to invest this much in the stocks and bonds and it's really important to me, catch you later, friend. Right? If someone says to me, well, Dave Ramsey said, put it in envelopes and eat rice and beans, like, be my guest. You want to stock 6 months in savings because Susie Orman told you to do that at 2 a.m. because you're up late at night, you can't sleep. Go ahead, right? I'm searching for the people that are overpaying their mortgage because they're already in the philosophy of, I want to be debt free sooner and I'm going to make a commitment to that. Now, if they're doing that and they're giving it to the banks, well, then there's a real question. If you needed that money back and you called your mortgage company and you said, hey, I've been sending you $1,000 a month extra for the last 2 years, and now something's come up, can you send me back the 24 grand? What do you think the bank's going to say? Not a chance in hell. Right? So would you rather stock that 24 grand and park it? I'm going to use the word park quite a bit. Would you rather park that 24 grand somewhere where you have access to it and it's growing at an interest rate and it's benefiting your family and it's giving you the pay down on the mortgage, you know, almost at the same rate you were looking for anyways? Or would you rather send it to them where they can reinvest it? Who in their right mind is going to give you, oh, I'd rather give it to the bank? Nobody. Right? So this is all about setting up questions and answers that just knock the dominoes down. So that's number one. Philosophy is I'm overpaying my mortgage. Philosophy two, I'm putting money in savings. How many people in this country came from a time period in their lives where they believed they had to stock money in a savings account for an emergency? Right? And again, we miss the mark when we get leads. And those leads give us indicators before you ever talk to those people, right? You look at someone on a lead who's somewhere in their mid 50s into their 70s. Grandma and grandpa said, get a good education, save for retirement, and park it for a rainy day. I mean, that's a big thing in certain cultures too, right? Park it in a savings account for a rainy day. How many of you have ever had a $90,000 rainy day? Right? So when you run into a client that's got significant money in savings, the real question is, what the hell are you putting it there for? What's the real emergency that's going to come up? Right? And I get real passionate about that one because if you look, I actually posted this in the Symmetry Financial Group agents page last year. Chase reported an all-time high on their savings accounts in April or May of the pandemic. For what? Everybody's just scared. They're scared their money's going to disappear. But I invite you to go look at the Great Depression, look at 9/11, look at 08, 09, look at the pandemic. How many insurance companies went up, belly up, and asked for money from the government? You're not going to find too many, right? If any, right? So my point is, these institutions are rock solid. So I go back to you and I say to the client, hey, like, why do you have so much money in savings? And they're going to tell me, well, I want liquidity. I want cash flow. Like, let them sell debt-free life to you. I want liquidity. I want cash flow. Okay, great. How much is the bank giving you in interest on that money? Now, you got to get comfortable asking uncomfortable questions and then get real silent, right? That's a Casey Watkins thing. This isn't debt-free life. This is insurance 101. Let the silence do the lifting. So there's that question like, hey, how much interest are you earning on savings? Let them answer. I'm not making statements. Nothing. I'm like, yeah, New Jersey, we call that bupkis, right? Well, what if I told you you can park it somewhere and make a minimum of 4% and still have cash flow? Would that be a good thing? Never ask a question you don't know the answer to. Be predictable about these questions. Would that be a good thing? Well, absolutely. Okay, so you're overpaying your mortgage and you're sending extra money to the bank and you're parking more money at the bank. What do you think the bank's doing with that money? They never know, especially with the savings. I'm like, they're lending it out for mortgages. And they're making, and now I go back to the interest rate they're paying, right? I do that in my financial fire drill. They're making 2.5%, which is the same amount they're paying, or they're making 3.2%. Sandpaper the pain. Find the facts and just put it in their face, right? And all of a sudden people are like, and they start to feel it. And then the question is, if I could show you a different path, would that be something you'd be interested in? Would it be okay if you made the 4% and protected your mortgage and paid off your debt and left more money behind than what you started with? Would that be something you'd be interested in? Again, what client is going to say no? right? And they're not overpaying their mortgage. They're not putting a bunch of money in savings. I'm not bringing this up. What does it matter? But if they're doing that already, I don't have to run through objections. I don't have to create a scenario where I become the enemy, because I love the way you presented this, Scott. It's just like, this is elemental, right? So I don't have to become the enemy to hop over the like barriers that they may create. So ultimately now, there goes back to that comment of, we're going to do the same thing you're doing now. We're going to using the same money you're spending now, right? And as I explain the debt-free life, and I do it so that, you know, I make sure they understand from me, I treat them like a fourth grader, right? And I don't want to take up too much time with this thing I did on the webinar. I do this every time. I put my arms up, it goes up, boom, boom, boom. It's super. Yeah. Thank you, Brett. You saw it. It's super simple, but it's like people are looking at you going like, oh, I got it. Okay. So it's just like, when the revelation takes place, it's just like, I'm not a salesperson for insurance. I'm an educator. I've just educated you on how to use your money differently. And I want to be partners with you on setting up a plan. So that's where my expertise comes in, right? You can't set this plan up for yourself. You don't have access to illustrators. You don't understand what a modified endowment contract is. You don't know how to balance whole life, term life, and paid up additions. And you need to meet with me again so I can go over this information. Essentially, at the end of the mortgage protection appointment, I'm doing the first debt-free life appointment, right? And again, Scott Forehand pushed me on that. Return on your time. How much are you worth, right? And then the real question is, why are you going to give them your time? So I was explaining this to Misty yesterday. So thank you for the question, Donna. So now I'm saying all this and I'm like, okay, which would you rather have, mortgage protection or mortgage protection that pays off your house early, gets rid of all your debt, gives you a tax-free, tax-favored retirement, and leaves more money behind than what you started with? They're always going to pick the second. I say perfect. So here's what we're going to do, right? It's that language you got to use and you got to adopt, and you got to find that, you know, internal drive inside of you that says, I'm going to win because I know I'm bringing something right. I'm being educational. I'm not taking advantage of someone, and they need leadership. If they had the leadership, they wouldn't be sitting with me anyways. So here's what we're going to do. Today, we're going to protect your mortgage. Listen how I said that. Today, we're going to protect your mortgage. Today, we're going to protect your mortgage. We're going to cover your mortgage. We're going to put some mortgage protection in place. And we're going to make sure that it's comfortable, right? I'm going to give you options. You're going to pick the one that makes the most sense, and then we'll fill out the application because we don't know yet if you qualify. Then I'm going to set another meeting because I have everything I need to create a plan for you. However, I only do it with clients of mine because it takes several hours and I do it at no cost to my clients. Now, what did I just do? I told them it's exclusive. I took it away. I made sure they understood that I'm not meeting with them if they're not my client because I'm busy. And it's going to take several hours of my time to plan this thing. And I want it to work for them. So today we're going to protect your mortgage, right? We're going to put some coverage in place. I have everything I need to create a plan for you. I only do this for clients of mine. I'm super busy. My schedule gets really packed. And we don't accept everybody into the program. Not everybody's a right fit for it. So here's what we're going to do. Let's get some mortgage protection in place. Make sure your family's covered. So God forbid tomorrow something happened, you got some coverage. Then we're going to come back to this in about a week. We'll pick a day and time before we leave here. And then I'm going to go over the plan I've created for you. And we'll work together to get all those other benefits in place. Does that make sense? Does that sound like a good plan? Look at that. They just bought twice. Twice. Now, let me tell you something. Why did I share I got fired from my job like 6 straight times? Besides, it's funny. It's a true story, right? I never believed in myself. I never believed in the power of self-improvement, self-growth. And I never realized that I am the keeper of my relationships. So every one of those jobs, I cause relationships to break down, right? You can interview Levon and Josh after this thing. I still have a lot of growth to go on relationships. But the truth of the matter is I couldn't spell insurance when I got to Symmetry, right? I'm not any smarter than you guys. I'm not any I'm no finance major. I have 2 degrees in recreation and sports. This is just a matter of how badly do you want to be able to work with people and bring a spirit to this thing of, I'm going to help you despite what you think of me, despite what you think of this program, regardless of what you expect. I'm going to sit down, I'm going to spend the time, and I'm going to turn your family into generations of wealth. And your grandkids are going to be calling me, maybe even praying to me in heaven and going, thanks, DJ Debt-Free. I don't have to work because of you. Like, just imagine saying that stuff. Where's that in the Symmetry handbook? It's nowhere.
You're going to have people bowing at your feet. When you put it like that, that's freaking amazing.
I heard Scott Forehand on a Debt-Free Life webinar say, and at this point, stand up from the table and take a bow.
Yeah.
Right? I mean, these are
Powerful.
people that have figured this stuff out. That like, this is exciting. We're not talking about death. We're talking about life. And a life beyond anything they dreamt possible when they sat down with you for mortgage protection. And how few agents understand that and will do this in an appointment. But you can't do it if you don't believe in yourself first. It's impossible.
So
In the product.
there is Keith, there's with the new DFL software, there's that financial fire drill. If you're unaccustomed to doing it, you can fill it out live online while you're talking to the people. Ask the questions. So if you don't know what to ask or you don't know how to do a financial fire drill, it's already there for you in the Symmetry DFL software. And if you have a question about how to do a DFL, or not just DFL, but any kind of fire drill, I would point you to Cicely or Ayers Newsom's financial fire drill is a great one.
Yep.
It's easy to use, simple, straightforward, ask all the right questions. You'll uncover, what your client really needs if you're there. All right. So anybody else? We got a few more minutes here. Anybody else have any questions for our special guest? Go ahead, Jesse Baker.
So my question is, what happens to the loan that you took against the policy? So you have your policy and you take the loan against your cash value. When do you pay that back? Like, we didn't talk about paying that loan that you took out against your policy.
You want to take this one? Or you want me to take it?
Please go ahead.
So the loan that you take out, it's going to be paid back over time one of two ways. Either you're going to do dollar cycling, where because you're already buying PUA with every single premium payment you do, that premium payment, the PUA that you're purchasing, can either be set to build more cash value or to pay down loans. The end result is going to be your loan capacity is going to go up because you're either paying down the loan that you had or you're creating more capacity. What I would tell you is you have the ability to switch directions either way. You can say, I want to pay back the loan with these payments, or you can say, I want to build cash value with these payments. What I would suggest you do, especially if we're in a situation where you're getting a good monthly compounded return, I would say you leave it set on buying more bank, putting more cash away. Because in the end, that compounded interest on more cash value, you're going to come out with a higher number than you will if you're paying down the loan, potentially. It also depends on the size of the loan. And that also depends on the structure of the loan. You have to take out $5,000 as a loan, okay? Do you take out as one $5,000 loan, or you take it out as five $1,000 loans? The end result for you is going to be the same. I'm going to pay advanced interest on $5,000 of loan. But if I have my PUA structured that I'm paying $500 a month, then I'm going to pay down one of those $1,000 loans in 2 months. And the way that the monthly compounding works, they take a year interest up front. Okay, but if I paid it back in 2 months, that means they're going to credit me back 10/12 of the interest they took. Whereas if I've got a $5,000 loan and it takes me 10 months to pay off a $5,000 loan, then at the end of that 10 months, they're going to credit me back 2/12 of the interest they took. So this is where there's strategy in how you take the loans and strategy how you pay back the loan, and it's going to differ. Every person is going to be different. Their goals are going to be different. The focus is going to be different. Their execution is going to be different. That's why we as professionals, when we write these programs, we need to look at that stuff. We need to look at the numbers. Got any other comments, DJ?
Yeah, I was gonna say, now if I could give the idiot's version of what Scott just said, because I'm gonna have to watch the recording of that 17 times just to understand, some of the things he said. Jesse, when I explain it, it's like, we take the loan, we pay off the debt, and we take the monthly debt service you were sending to that debt, and we just send it back into the insurance carrier. We take the loan, we pay off the debt, we take the monthly debt service you were sending to that debt, and we just change the address on the envelope. Instead of it going to the bank or the creditor, it goes to the insurance carrier. Then I usually say, when it goes to the insurance carrier, who are you paying back? Because I want them to say, myself, right? Look, you just even did it. I wasn't even directing at you. And it happens. When they start saying that, they start to explain to themselves that they're paying themselves back. By the way, I'm terribly sorry. I forgot to put the glasses on until now. It's bad form of me. But you see my point, Jesse? It's like, man, everything Scott just said, like, is the truth, right? And it's important to learn the math and learn the functionality, because it just takes you from here to here. I can't get there yet. I'm still watching the videos and learning, but I know I can explain to them, you take a debt, you take a loan, you pay off a debt, you take the monthly payment you were paying to that debt, and you send it back to the insurance carrier, thereby repaying who? Myself. Okay, cool. Then when you have enough cash value, you take the next loan, you pay off the next debt, right? And at least for me, it's important that it's kept kind of, I'll call it dumbed down.
Simple.
Because if they, yeah, simple, thank you. Because if they don't understand what the heck's going on, and they don't completely and utterly just trust me with everything that they got, I'm going to have challenges getting them over the finish line. Me, I tell my clients, and Scott's right? Like, the ways to mess this up. I tell them there's only one way to mess it up. There's only one thing that keeps people from doing this process. Fear. I don't trust you. I don't know you. I don't think it's going to work. I don't understand. It's just fear. Right? So I make sure the client understands. If you're afraid and this isn't going to work for you, then you're not right for us. Right? And I tell them it's fine. Right? There's so many people out there that will be a part of this, that if you're hunting for everybody to be a part of it, you're setting up failure for them and you. So I just tell them, like, there's only one reason not to do this, because, go look at every bank. Where do they park their money? Whole life insurance, right? Go look at every wealthy person. How do they usurp taxes? Whole life insurance. How are the biggest companies in this country, how were they built? Whole life insurance. So have they figured out something that we don't know? Obviously. So if they're putting large amounts of money, why would your $600 a month disappear? It wouldn't. So the only reason to not do it is fear. And if that's, something you need to think about, then think about it. Get back with me, because I got a whole lot of other people that are banging at my door.
Right on. Anybody else got a question for DJ?
Okay.
Hi, Rory.
Hi, Scott.
Hey, Rory, I met your son, Jordan.
Yes.
Very
yes.
good. Had a nice little conversation with him.
Oh, very good. I'm glad. Thank you. Thank you for that. Question. Here's a scenario. Have a customer who has the only debt they have is their home, which is they've been in it 2 months, right around $200,000, 30-year mortgage. They're paying, I think the more interest rates, high 2s or maybe right at 3. So if they're interested in DFL just to, obviously to grow their wealth, is it beneficial for them to pay that loan off, or since they're making more money with DFL, just worry about putting that in the bank and grow that, since they've got a really low interest rate? What would the recommendation be there?
I prefer the math guy to answer that one.
To illustrate the reason what I'm getting ready to say, run it through the DFL system or YFB system. But the end result is, as long as they have a DFL structured so that there's PUAs being purchased, then doing this will create more money in the long run. Okay, so that doesn't mean they can't take the money out, and they should. Okay, because the elimination of interest is the same thing as gaining cash. It's money that you would have lost over time. Okay. So if I'm going to pay $180,000 in interest over 10 years, or I'm going to eliminate $90,000, then what I've just done is I've put $90,000 in my pocket. So the DFL solution does both. It eliminates the debt faster, and it creates that permanent perpetual wealth that grows and grows on itself. So if your client is thinking that they want to pay off their mortgage fast, great. Do it with a DFL. Pay the money into the DFL, capture, sequester the money, take the money out, pay off the mortgage. They're going to come out better in the long run every single time.
Yeah, park it where you gain interest or give it to some place you don't.
Right. See, DJ has a great way of taking what I say and making it available and easily understandable for the masses. So great.
This is why we're going to make the best like debt-free life team in the history of history, Scott. Right?
Yeah. I got the math part down. You make it understandable to people.
This is perfect. I'm so glad Keith is on here because, you know, I'm married to Scott. I've been listening to this for 2 years, but Keith just breaks it down. I'm like, I get it now. I totally get it now. I've only been listening to it for 2 years. I went to the class myself too. So
listen, Donna, we all owe you a debt of gratitude. You took the bullet for the rest of us. So.
What? What, marrying him?
Yeah.
All right, Paul has a question. Paul Dunseed.
Hi, Scott. If you and I are on the phone.
You are not Paul Dunseed. You are much better looking than Paul Dunseed.
If you and I are on the phone, I'm a current client of yours. How much does this cost for me to start in order for you to do this for me?
You want to do one of these deals and you want to split the deal with me?
No, I'm your customer. Interested in.
Great question. The answer is whatever you want to spend. So the idea with debt-free life is we're going to find money that you're spending inefficiently. Overpayment of debts, eating too much Starbucks, got money that you're parking in a savings account, got a 401k that you're overfunding, overpaying your mortgage payments. There's lots of places where you find money. So there is no one size fits all. What we're going to do is we're going to figure out everywhere that you're spending money inefficiently. And then there's another part of this, right, DJ? The death benefit piece comes into play too, because now we're talking about potentially using that as first to maybe cover some of the mortgage protection requirements. And then you can use one more thing. This is just standard life insurance dogma. How much money do you make? How old are you? Okay. How many years do you have left until you retire? I make $100,000 a year. I'm 50. I'm retiring at 65. Your worth to your family is $1.5 million.
No, I understand that, but how much?
Yeah, I have a question for you, Scott. Let's say hypothetical, you're paying $120 a month into a life insurance policy through work.
Okay.
Could you cancel that policy that's going through work and then start up a DFL with the same $120 a month?
How fast can I say yes?
I guess that's
It's no brainer. I mean, if you're spending that much money on a work policy, a DFL is going to have a much higher death benefit to begin with, and you're going to be able to capture and sequester probably 2/3 of that money as growth. What do you think?
So there's no minimum to start, and can it be added to later down the road if you wish?
You can add money in. Go ahead, Keith.
No, I was just going to say to your point, Paul, right? This thing works, right? And it's based on contribution, like
Okay.
premium, spend. Like I like to flip language to my advantage. So we're going to take the money you're spending and we're going to invest it differently. See how I flip that?
Yeah.
Right. We're going to take this premium and we're going to make it a contribution. People like to contribute to themselves. So the point is, right, it's life insurance, right? And if I didn't say it well enough, like this thing works the best with people who already wanted life insurance. That's why I'm so behind, like Symmetry brings us debt-free life opportunity, you know, as much as we want, because there's so many people that want life insurance. So the idea is, can we take what you have available and make it work better for you? So if
Gotcha.
what you have available is 120 going to a work policy, what you have available is this going here and that going here, can we show you a path to victory that you are comfortable with to be able to create a plan that gives you all these benefits?
I get that part. I understand that. But let's say for the sake of the argument, we go out tomorrow, we cancel the policy at work. That gives us $120 a month to start this new plan.
Yep.
A year from now, life has changed. Things are getting better. Instead of having only $120 available per month to play with, now I've got $500 available to play with.
Mhm.
Can I up that original 120 to 500?
You
And
can't up
if-
to 120, no, but you'll be able to put that 500 in there because of the PUA.
Okay, so the 120 is a consistent, and then let's say I had an extra $50 one month, I can still pop that in there.
Yep.
As long as the minimum 120 is met, then I can do
There's
it.
a ceiling. Remember, we talked about that modified endowment contract. So there's a maximum amount that you can contribute on an annual basis. Okay. And there's a minimum amount that you have to pay to keep the policy active. That's going to be the cost of the term plus the cost of the whole life plus $100 a year for the paid up addition rider. That's your minimum payment on an annual basis. The maximum, depending on how you structure it, which is what is the size of the term, that's going to increase the size of the paid up addition rider. So I did one yesterday. It's $200 a month. That's their target premium. However, they can contribute $17,000 per year.
Okay.
So, so right now they're paying $200 a month. The next year, when the guy gets a $1,000 a month raise, he's going to put in $1,200 a month, and he has room to do that. So this is why when you're talking to your clients, you have to ask these questions. What's your financial goal? Do you see a raise in the future? Do you see a detriment in the future? Figure out where their number is, and then you can start playing with it to bring down, okay, like I had one I did earlier last week. They had $3,000 or $2,600 a month they want to spend. So that's two $1,300 a month policies. But I don't want it all going into PUA or all going into whole life and term. So I pulled the primary policy down to $500 a month. And then that extra now they've got $800. That's how it started. But then I tweaked it again and pulled that $500 down to $300. And now they've got $1,000 a month going into PUA. You play with it and you just manipulate it based on what the client wants.
What sets up the umbrella? Where's that limit? The income
The term.
or the term?
Yeah, the term rider is what creates that umbrella that shelters it from the IRS intrusion. And the term typically is going to be 10 times the whole life value. So if the base policy has a whole life of $50,000, then the term is going to be $500,000.
Right.
And then you can manipulate it within there depending on the carrier that you're working with. You got any other comment? I'm sorry, I didn't mean to steal your thunder, DJ.
No, see, what's beautiful about this is I'm learning some stuff right now, but I'm able to say to the folks who don't know all this stuff, I don't know everything he just said either, but still successfully selling this thing because my answer would have been, yes, it's flexible. But that's why they call it flexible paid up additions.
Right.
It's flexible, right? And I've learned enough inside of the Illustrator on how to make sure it's flexible because I can give it an annual max cap. So what I'm telling them, this is a roadmap, right? This, this doesn't mean like if you don't give them $1,000 a month for the next 20 years, like there's problems. There's flexibility. You can put more, you can actually go less. And I tell them what the minimum is. And that minimum is what Scott's outlining as the premium, right? To be able to maintain the insurance. I know for me, like dumbing it down has really helped me create sales as much as I can. And there are some people that want it explained very specifically with the kind of knowledge and detail that Scott has, and maybe they're just not my client, and I accept that. Right? Or now I'm going to kick them over to Forehand and do some splits, and that's what you guys should be doing. Like, don't waste any time. I'm not joking. Right? If you're in my agency, don't waste any time. Kick them over, make your 40%. I just had this girl tell me today in a little training. She's like, yeah, I don't feel comfortable asking the annuity questions at the end of the appointment because I just don't know enough about annuities yet to ask them, would they, would it help them if they had some of their retirement money? I forget the question. I'm tired. Right? But what is my point here? I was just like, wait a minute, there's this thing called Quility Retirement Services, or people inside of your agency who understand annuities. So would you rather like wait until you learn it? Would you rather just get 40% for doing nothing? She was like, what? I'm like, yeah. Wouldn't you rather just get 40% for like providing a name and a phone number and a little bit of information? And Scott pointed it out. It's right there inside of HQ. You can do a financial fire drill. So to answer your question, Paul, not to belabor it, yes, they can do 120. Yes, they can do 120,000, like whatever. Yes, believe in it. And we'll structure it so it works for you. And it's definitely flexible. So if you make more money down the road, cool. If you have something come up, you got a ton of cash flow, cool. Right? People just want to feel like that every scenario that could happen, they're taken care of. Right? Because that's that big 4-letter word, fear. Well, what happens if I can't send 2,500 a month? And we've set it up for 2,500 a month. Okay, cool. Don't send 2,500. Here's the minimum it'll take to maintain. Now, if they can't afford that minimum, then we got problems, right? Or, hey, you can take an automatic premium loan, an APL, and it'll cover your premium for that month, and then you can pay it back. Like, that's the beauty of this thing. It's flexible.
Yep.
Where's Courtney? She had her hand up earlier.
Courtney Nolan. She's still here?
Maybe she left.
I think it was
Desario.
Desario.
Oh, Desario?
Maybe Brett can ask. Oh, here she comes.
Hey, Scott and DJ Debt Free. I have to run to an appointment. You guys have a great evening. Thank you so much for all that you do. Appreciate it.
Make sure you set them up for a debt-free life.
Yeah, there you go, Tom.
Hey, Courtney.
Always.
Later, Tom.
All right, Desario, you're on. You're
You got
muted.
no mic.
She got no mic.
I think the
Okay.
mic itself is muted.
Rookies.
Me,
Brett's just
hear me
messing with
now?
her.
There you
Yep.
go.
There you go.
Okay, sorry. No, my quick question was, when it comes to that additional savings vehicle down the line with these plans, do you guys have anything specific that you're using or doing? I think I've missed that on other appointments.
I started
Sure.
a bank.
Okay,
So like the one I did yesterday, it was a big DFL and then a equal size term policy with the same carrier that's fully underwritten. And then that's convertible. So when the primary bank fills up with cash and you have to, start putting money in a savings account, as the illustration will show you, that I'm just simply going and converting that term program into another DFL bank and then start putting money in there. And the beauty of
Got
that
it.
is they've already gone through underwriting. It's already approved. It's a guaranteed conversion. And for selfish purposes, I get paid another commission.
awesome. I knew you had talked about it before, but I didn't take good notes because I wasn't at a point with any of the policies I've done that we really needed to worry about that. But I have one coming up that will be.
Yeah.
So awesome.
And I usually,
Yes,
when I'm
this
doing
ends
that,
at 7.
what? Sorry.
Sorry.
When I'm doing it, I'm actually looking at what the budget is for the program. So the one I did the other night, this is the one I was just talking about, $3,000, $1,500 a piece, or actually $2,600, $1,300 a piece. So I took all that money, $2,600. The premium for the term was $190. All right. So now I've got $2,100 that I can spend on the primary bank. So I got the primary bank set to where it was going to be like $300 or $500 as a base price. But all the rest of that PUA money is going in there. So the bank's going to fill up even faster than we originally anticipated, which means I'm going to be flipping that switch to turn that term into another bank quickly. But this is from an efficiency perspective, that's the most efficient way to build cash, right? And again, all that money that I looked at that we found, that was just repurposed money. So this is actually a zero cost program for them. So they're getting massive amounts of life insurance. They're getting a private bank. They're getting to cycle through their dollars. They're getting way more money collected and saved. So that one other thing, this is something you were talking about, Keith, right? When I'm doing this and we're saving that money, I'm paying and getting a net zero gain. I'm paying the debt while I'm paying into my private bank, pulling the money, paying the debt. So now the debt's paid and I've got my money. I've got my cake and I'm eating it too. And I shouldn't be doing that because I'm diabetic.
But that was the coolest thing you've said this entire webinar.
All right,
Thank
I like
you.
it.
Did you get the professor and the
Rory, go ahead.
Question: If you have a customer that has sold a business or a property and they want to dump all that money into their DFL, is there a cap on that?
Depends on the carrier. Lafayette's 300,000, Foresters is 200,000, Mutual Trust is 100,000, but you can get exceptions with Mutual Trust. And then you have to look at multiple year contributions. So the one I did last summer with the guy in Texas that sold a ranch, it was $1 million liquid. So we did $300,000 in year one, had a $7,000 premium. So $300,000, $7,000 premium. Year two, $300,000, $7,000 premium. Year three, put the balance of what was left in there. And by that time, the interest plus the dividend was enough to pay that premium. And we pulled the premium down to where it wasn't any PUA in it anymore. So at that point, where he would have been at $1 million liquid. And where we put him, he's at $1.6 million liquid in 7 years through the growth, the interest rate, and all that other stuff. So it's a no.
Where did you have him park the money?
Say again?
Where did you have him park the rest of the money in the meantime?
Wherever he wanted. We didn't go into that. It's probably just, I think I told him to buy some CDs, high interest CDs, because when you're buying a CD for 300 grand, they're going to give you 2.5, maybe 3.5 points. Especially if you don't need it for 2 years. So, you can get some interest on it from a bank and it's safe.
Real question, was there no value in writing an annuity, even a short-term one?
I didn't think of a short 1 year annuity, but the return you're going to get on a 1 year annuity might be 1%, 1.5%. And that would be less than what you get in a CD. And plus your money
money locked up in a CD though?
No, it's no more locked up than it is in an annuity. I mean, annuity, you're going to lose 20 points if you take it early, 20%. And in a CD, you'll probably have like a 10% or maybe a 5% penalty for early withdrawal or early cashing it in early. So each one of these things is different every time. It's unique. Each one of these cases is unique. All right, we got 2 more minutes. Anybody else? Or are we done? See if there's any questions in the chat.
I do have a question.
Go ahead. Hey, Amani.
Hey. So this is just like this question is for the debt-free life of Circle. I want to say I just want to make sure that I have this that I have the right perspective of it, because I'm not familiar with debt-free life at all. So what I got from you is you put the money into the bank that pays the insurance, right? Well, you put money into the bank account. You open up a bank account, right?
The way debt-free life works is debt-free life is a life insurance policy. So all you're doing is paying your premium to your life insurance company. The bank, right? Is a bank.
Okay, but okay. Let me start over. This is about paying off the loan with debt-free life.
Paying off the home?
Loan.
Okay.
Right. So you say you put your money into the bank, right? Let's go with the example that you gave, $1,000.
What loan are you paying off?
Whatever loan. Let's say I have a car loan that I need to pay off.
All right, so you're paid off.
Okay.
All right.
So this is just, whatever, this is, this is not actuality. This is just, just an example. I'm just trying to get a clear understanding. So let's say I'm paying off my car loan. I'm putting in $1,000 into my bank account. Now you said with the old way is you put the money into the account, you get a loan from the bank, and then you end up paying the bank back the money.
The
right?
only way
And
that
then the
people are
bank
paying that off,
money.
you're spending the money gets deposited into your checking account with whatever bank you bank with. You write a check
Right.
out of that bank account and you pay your car loan. You have a net zero sum gain. The money's gone forever. You're never getting it back. And the only benefit you get out of that is if you owe $1,000 less on your car. The bank
Okay.
in the interim, while the money's sitting in your checking account, the bank is lending that money out, earning money with it over and over and over. The way you do it with the DFL program, same money, same bank goes into your checking account, but then it stops. Then you write a check, but not to your lender, not to your car loan people. You write a check to your private bank, which is in essence paying your life insurance premium. Okay. And then when it hits your life insurance company, it gets split into different ways. At least 68% of it should be split towards PUA purchase. Plus there's some portion of it goes to cash value. So that means you spend $1,000, it goes up into your bank. Your banks, you pay your term rider fee, you pay your whole life fee. The rest of it goes to cash value of the bank, and then you take a loan, and then the loan gets deposited right back into your checking account. And then the checking account, you write a check to your lender and pay your car loan. So it's still the money's going from A to B. Still going from A to B. But where the DFL program, it goes from A, stops, goes up into your private bank, comes back down, and then continues on to B. So
Okay.
the access of the action of moving it up into your private bank is capturing that money forever. So that next year you can use it again, and next year you can use it again, and next year you can use it again, and it's earning interest for you every year, and it's earning a dividend for you every year. Keith, make that simpler for me.
You put the money in the bank and you transfer it from the bank into the insurance. Then you take it back from the insurance and pay the debt.
Thanks, Keith.
Okay, I'm just trying to clarify that what I have written down.
Yep.
Is I'm just making sure that I understand that what you both guys said, because Scott, you said that one, and then we have DJ Debt Free. He's speaking in my terms. So you put the money into the bank to pay the insurance, you get the loan from the insurance, you pay off the whatever debt with the loan, and then you end up paying whatever you would be paying the debt. You put that back into your bank. You end up, okay.
Put it back in the insurance company.
The insurance company, your bank.
I would like to buy a policy from you, Amani. You just said it perfectly.
Okay, I just want to make sure I had to put this in
You transfer it from your bank into the insurance company.
Okay.
Then you borrow it back from the insurance company back into the bank. Then you pay off the debt. Then you take the money you were sending to the debt and you send it to the insurance company.
Okay. Now, are there any particular qualifications like far as in health and monthly income with getting involved with Debt Free Life for clients?
It's uniquely designed for every family to be able to take advantage of the program.
Okay, as any insurance policy would be, right?
Right.
Okay. Thank you, guys.
No different than having someone who wants to give you 10 grand a month, but just had stents put in last month, right? And had cancer a year ago. They're going to qualify for insurance.
Right. Okay.
Keep that in
Thank
mind.
you.
All right.
Thank you.
Keith, thank you very much for coming by, man. I appreciate it.
Thanks for having me.
I'd like to hire you as a translator.
Yes, he does need a translator. Perfect.
I'm going to start getting texts from Donna. Can you speak to Scott for me, please?
Can you explain what he just said to me?
I just want chicken. Tell him that.
We're having chicken for dinner, damn it.
Right on. All right, everybody, thanks for coming. Hope you got something out of this. If you're a DFL writing agent, great. Go out and write some. Help your families. Help them get out of debt. We're on the march. $1 trillion with all Symmetry. And if you're a potential client here looking at debt-free life for the first time, hopefully you can get through all the stuff I said and listen to Keith because he explains it better than I do. So good luck to everybody. See you in a couple weeks.
Thanks, everybody.
See you guys.
Bye, everyone.
See you guys.
Bye.